This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Red hot, the Nasdaq had its biggest point gain in a year, fueled by tech stocks that have been the ultimate market winners this year.
Oil slick Exxon and Chevron saw their profits grow 50%. Sounds good, but investors were left wanting more.
And market monitor CVS reportedly wants to buy Aetna, but should investors like you buy CVS Health shares? This week's Stock Picking Pro has an emphatic answer. Those stories and more tonight on Nightly Business Report for Friday, October 27th.
Good evening, everyone, and welcome. What a day for the Nasdaq. The index was the clear standout, basking in the glow of blowout earnings from Amazon, Alphabet, Microsoft, and Intel that we told you about last night. Amazon and Alphabet closed at all-time highs and above the $1,000 a share mark. The two Dow components, Microsoft and Intel, were both up more than 6%. Microsoft hit a new all-time high, and Intel was the best performing stock today on the blue chip index. Today alone, Amazon added more than $61 billion to its market cap. Alphabet's market cap now tops $700 billion, about twice the size of ExxonMobil. Microsoft's market cap pushed past $650 billion just 1 week after hitting $600 billion. Intel shares hit a 17-year high. That, along with Apple saying it's seeing strong demand for its iPhone X, sent the Nasdaq up more than 2%. And in fact, that index easily outperforming the Dow Jones Industrial Average, which added 33 points to 23,434, and the S&P 500, which gained 20 to hit a record. The Nasdaq was the big winner for the week as well.
Well, the global benchmark for crude settled above $60 a barrel for the first time in more than 2 years. Prices were supported by speculation that the major oil-producing countries will extend an output cut agreement through the end of next year. That sent Brent crude higher along with domestic crude. The steady price rise in oil has been somewhat of a tailwind for the major oil producers. Both ExxonMobil and Chevron beat earnings and revenue estimates. Both say profit grew more than 50% in the most recent quarter, but the reaction was mixed, and Jackie DeAngelis explains why.
It's no secret that the energy sector has been beaten down. Now, some of the biggest energy companies in the world are signaling that the tide may be turning. And the change is due in a large part to the steady climb in oil prices. For the world's largest publicly traded oil company, ExxonMobil, better performance in its exploration and production and also refining businesses also drove its solidly higher profits.
All three business segments delivered solid results, generating cash flow from operations and asset sales that exceeded dividends and net investments for the fourth consecutive quarter. These results were achieved as the company worked to safely bring our Gulf Coast manufacturing operations back online following the devastating effects of Hurricane Harvey.
Hurricane Harvey, which shut down about a quarter of U.S. oil refining during the quarter, resulted in a 4 cents per share hit for Exxon. But higher oil prices weren't enough to help Chevron. The oil major did report a sharp climb in profit and revenue, and cash flow from operations, a key measure of financial health in the industry, rose about 60% in the first 9 months of the year. But the company's decision to drop its U.S. production hurt results, which in turn offset the rise in oil and natural gas prices. The company also said spending on large projects is being scaled back. And reducing spending was a theme that ConocoPhillips mentioned as well. Like Exxon, the company reported better than expected results for the third quarter, but slashed its capital spending budget by 10% for the current year. Cautious optimism is how analysts in the energy space were looking at these reports. Crude prices, of course, are still the key to the future profitability of these companies, and it's tough to know which way they'll go. On one hand, persistent troubles in Iraq, Venezuela, and the questions surrounding Iran are all reasons supply could be threatened. Prices could move higher.
I think crude oil prices are going to continue higher over the next 2 months. My objective is $60 a barrel. I think once it gets to 60, though, it's going to have trouble going any higher than that.
On the other hand, should OPEC not extend its production cut and shale producers overpump, a slide into the 40s wouldn't be surprising either. For Nightly Business Report, I'm Jackie DeAngelis.
Merck was the worst performing stock on the blue chip index today. That company said a cyber attack over the summer caused a temporary production shutdown worldwide and cut revenue by at least $135 million in the third quarter. The company also reported a loss of market share for many of its older drugs. But earnings came in ahead of estimates, helped by cancer immunology drugs. Nevertheless, shares dropped 6% during the regular trading session. Shares fell further in the extended session after Merck said it withdrew a marketing application for a cancer drug in Europe.
Well, halfway through earnings season, here is where things stand if you follow these items. According to Thomson Reuters, 74% of corporate earnings reports have come in above estimates. 9% were in line, and 17% got the failing grade. They missed, and that's better than the long-term average. At this point, the growth rate of the tech sector earnings has shot up to more than 18%.
Not even hurricanes could keep this economy down. The gross domestic product, the broadest measure of economic activity, grew at an annual rate of 3% in the third quarter, and that was better than estimates. This is the first time, in fact, in 3 years that the U.S. economy has seen back-to-back quarters of 3% growth. And this comes as the University of Michigan's Index of Consumer Confidence hits a 13-year high.
A new report from the White House predicts that corporate tax cuts alone would produce reliable economic growth of between 3 and 5% a year in as little as 3 years. The report also estimates that reducing tax rates for business from 35 to 20% could boost the overall size of the U.S. economy by upwards of $1 trillion over a decade. Democrats debunk those claims. Academic research is divided on the connection between tax rates and growth rates.
Last night, we told you about some questions concerning Morningstar's 5-star rating system for mutual funds. So if the stars alone can't guide you, what can? Tim Maurer is Director of Personal Finance at BAM Alliance, and he's here to give us some guidance on that. Good to see you, Tim. Welcome back.
You too.
Let's
Thank
start,
you very much.
First of all, with the Morningstar star system. A lot of people use that, but if you choose not to use that system, or if you question it, what other data would you recommend that investors look at?
Well, here's the interesting thing. The Morningstar star system, the fact that it is largely defunct, is not new news. The sad news that came out in the Wall Street Journal report was that people have actually been relying on this, not only individual investors, but also financial advisors. The good news is that Morningstar itself can actually be used as an effective tool, especially by individual investors. You just start by largely ignoring the star system.
The stars, though, were a very convenient hook, not only for individual investors to look up and glom onto, but as you point out, for financial advisors to sell. It's a 5-star fund. I wouldn't put you in a 1-star fund, so it worked very well. I know you well enough to know, Tim, that you lean toward index funds and you believe that they are an advantageous bet, not so much because of performance, but because of the connection between performance and low cost and low turnover.
There's no question, Tyler. Inside of that report by the Wall Street Journal, there was a subplot that may not have come through, and it really was proving that indeed active investment managers really ultimately end up struggling in the long term to beat their benchmarks. That's one of the reasons that the 5-star funds eventually became 2- or 3-star funds. So yes, you are correct. My preference is for more passive asset class management funds. Index funds in some cases are going to be the most appropriate thing for many people. And so you can still do a good job of finding those. Using the Portfolio tab on Morningstar.com, you can look specifically at what exactly is held inside of that mutual fund. So if you need a large cap fund or a small cap fund, on that Portfolio tab, you can use the tool effectively to determine what the asset class is. And then, as you said, we want to look for lower expense ratios. That's a good sign that it is a more passively managed fund and will likely do better for investors in the long term as a result.
Also, you recommend portfoliovisualizer.com. We just had it up on the graphic that we showed. Why do you like that particular vehicle?
Well, Portfolio Visualizer takes it a step further, and it really does a better job at helping you craft a whole portfolio, because that's one of the other problems that I have with this report. The message is still coming across that it's all about the funds, and it's not. That's how Wall Street has been selling investment products for many, many years, saying that it's all about the funds. It's really all about the asset allocation. Over 90% of one's long-term return has more to do with the asset allocation, that is how you construct that portfolio, than exactly what is inside of it. So I would caution investors to keep their focus on first things first, start with the allocation, and then fill that portfolio with the lowest cost funds, which you may actually find on Morningstar, but you can absolutely put together on Portfolio Visualizer.
Tim, thanks so much. Have a wonderful weekend. Tim Maurer,
you do the same.
with
Thank
BAM
you.
Alliance.
And still ahead, it could be the biggest deal of the year, CVS Aetna. Our market monitor has a strong opinion about CVS shares, and he'll share it in a moment.
Catalonia's parliament voted overwhelmingly to declare independence from Spain, but the story certainly doesn't end there. Later in the day, Spain's prime minister dissolved the Parliament of Catalonia and called for a regional election in late December. It's that country's worst political crisis since the 1970s and put Spain in uncharted territory. It began when Catalan leaders held an independence referendum defying a ruling that declared that illegal. Spain's benchmark IBEX 35 index fell after the vote, and Spanish bonds slid as well.
Here in the U.S., federal prosecutors are reportedly investigating foreign exchange trading at Wells Fargo. According to the Wall Street Journal, information from the bank has been subpoenaed, and a few bankers who worked in that unit were recently fired. The investigation, which revolves around a trade made within the past 3 years, is in the very early stages. Wells Fargo has been under increased scrutiny recently because of its fake accounts scandal.
Yesterday, we told you about that CVS Health was reportedly in talks to buy Aetna, a deal that would be the largest health insurance deal on record. Tonight, Bertha Coombs outlines why each company may want to see this deal get done and what it could mean for you.
Most of us know CVS as the drugstore on the corner, but it's more than that. The firm also negotiates drug prices and manages drug benefits for big insurers like Aetna. Now, CVS wants to merge with its partner, believing together they can offer better value to large employers and their workers.
What's important in this industry is figuring out how we're going to influence people to get the right care, to not have too many medical tests that drive up costs, to go to the right venue, which is the lowest cost venue.
Together, CVS and Aetna would be a formidable rival to United Health Group, which not only offers insurance, but is beating the competition by packaging lots of data services to help firms drive down health costs with all-in-one pharmacy benefits, and it has physician groups and outpatient surgery that are cheaper than hospitals. CVS and Aetna would have a lot of the same pieces and something more.
One key asset that CVS has that no other company up and down supply chain has is its retail pharmacy. And that's a key point here, and their opportunity here to leverage those assets and also minute clinics as well.
On the consumer side, the deal would also give CVS more muscle to fight off the threat of Amazon entering into the pharmacy business by offering more value beyond just low prices.
An integrated firm with Aetna and CVS assets would be able to understand where people's finances are, what their drug use is, and Aetna has actually been making a huge push on the artificial intelligence and analytics piece.
Analysts say apart from some overlap on Medicare drug insurance plans, there don't appear to be many antitrust hurdles to a potential deal. But investors may balk at the price. Sources say CVS is proposing to pay $66 billion for Aetna, which would be a record for a healthcare merger. For Nightly Business Report, I'm Bertha Coombs.
And CVS is one of our Market Monitor's picks this week. He's Doug Butler, portfolio manager at Rockland Trust. Doug, welcome back. Let's start with CVS. A down day for that stock today, but you like it. You liked it before the deal. I take it you like it even more after. Explain the thesis.
We very much like the deal, and we think that management has had a fantastic week, even though that hasn't been reflected in the stock price. Stock is down about 10% this week. But management really made two huge moves this week. The first one they did was they acquired the business of Anthem from Express Scripts, which they had to do before they made this subsequent move to make a move on Aetna. And that really allows them to, become the full service, the top to bottom, the vertically integrated healthcare provider with insurance, with PBM, and then with that retail pharmacy that we heard about a moment ago. We think that that really is a great move, and it helps Amazon proof them to some degree to get not just focused on the retail and the PBM side of things.
The next stock is Alphabet, and earlier in the show we detailed the fact that it has had a pretty stellar week. Alphabet's market cap now tops $700 billion, twice the size of ExxonMobil. You still like it, though? You don't think it's gotten too expensive?
We don't. This company still makes an extraordinary amount of money. And the shift from traditional advertising to digital advertising, that shift is still ongoing. Additionally, I think Alphabet is one of the better ways to play the data explosion. We may think we're late in this game of data coming in from everywhere, but really, we think that the data explosion that comes not just from people demanding information on the internet, but really also from once machines start talking to each other and to everything around us, there's going to be a coming data explosion, which is one of the reasons why we think Alphabet is one of the best positioned names to play in the tech space.
Let's get to pick number 3, which is AT&T. You like this space, you like Verizon, you like Comcast as well, but you're recommending AT&T. It has had a bit of a rough year, down 7%, and there are a lot of people who question the wisdom of the Time Warner acquisition.
Yeah, the Time Warner acquisition, I think they're looking to get scale. I think throughout corporate America, you're hearing a lot about needing to get scale. And one of the things AT&T does have, especially with this Time Warner deal, is it has increased its scale there. I think we really like Time Warner in the fact that they are still adding tremendously to their broadband capacity and capabilities. And the video losses that are really the headline drivers lately are probably less important long-term than the fact that they are still going to be the place that everybody turns to for getting information.
So we like 3 stocks, Alphabet, and 2 others that are all made up of letters, CVS and AT&T. Doug Butler, it's a theme. Doug Butler with Rockland Trust.
Indeed.
Thanks.
Thank you very much.
Shares of JCPenney hit an all-time low today, and that's where we begin tonight's market focus. The struggling retailer slashed its full-year financial forecast, saying it had to heavily discount its apparel ahead of the holiday to get rid of excess inventories. While the move temporarily lifted sales, the company said it will report a larger-than-expected loss in the third quarter. Shares took a dive, falling nearly 15% to $3.12. AbbVie said strong demand for its rheumatoid arthritis drug Humira helped that company top street expectations. It also said it expects to sell more of that medication by 2020 than previously thought. In addition, AbbVie is raising its quarterly dividend 11% to 71 cents a share. AbbVie shares rose more than 2.5% to 91.93. And the paint maker Axalta was reportedly approached by Dutch rival AkzoNobel about a potential merger. Reuters says Axalta is in the early stages of considering a deal. Shares of the company jumped nearly 17% to $33.15.
Colgate-Palmolive said increased advertising spending helped lift sales. Those results were better than expected, while earnings matched estimates. The consumer products giant also said it expects to get hit with higher charges from its restructuring program. Shares on the day off 1% at $70.40. And despite beating earnings expectations, Goodyear saw its shares hit after the company slashed its forecast for the 3rd time this year. The nation's largest tire manufacturer cited weak demand and higher costs for oil and rubber. Shares dropped more than 4% to $32.18.
New York is implementing what will be one of the most comprehensive paid family leave policies in the country. The law applies to full-time and part-time private employees, and it goes into effect January 1st. But the reaction from small business owners is mixed. Kate Rogers reports tonight from Brooklyn, New York.
At Brooklyn-based Uncommon Goods, workers bringing home a new child or facing challenges in caring for a sick loved one don't have to make tough decisions about choosing work over family. The company has a paid leave policy in place, guaranteeing primary caregivers 8 weeks off. CEO Dave Bolotsky says it's not only good for workers, it's good for business.
Providing our workers with an opportunity to balance their personal needs and work requirements is something that we think is in our business interest as well.
On January 1st, other small businesses in New York State will be offering similar policies as the state implements what's being hailed as one of the most progressive paid leave laws in the nation. The program, phased in over time, allows up to 12 weeks of paid time off for a new child, including adopted or foster children, as well as ill family members. With a lack of movement at the federal level on a paid family leave policy, 5 states, including New York, have passed legislation of their own. Critics say the law places an unfair burden on small businesses in New York State who are exempt from the Federal Family and Medical Leave Act, which guarantees unpaid time off to employees at businesses with 50 or more workers.
It is the most expensive and expansive such program in the United States. Administratively, it's going to be very challenging for them, and especially for smaller companies. If it's a key person or a very important member of the staff, they're required to permit them take this leave.
And while many on Main Street are focusing on higher priority items in Washington like health care and tax reform, experts say paid leave policy should be on the radar.
It's actually very complex with a lot of nuances. There's a lot of monitoring, a lot of reporting going on. There's a lot of different regulations within each state and jurisdiction. So I think it's something that they do need to be aware of and could be very complex to comply with.
And while Bolotsky acknowledges those challenges, especially for smaller companies, he maintains the benefits outweigh any cons, especially in the long term.
Parents being with their children is actually a good investment. It's been proven to help with child development, so I think it's actually a positive in terms of long-term investment.
New York among those states leading the charge to bring about more flexibility for American workers. For Nightly Business Report, I'm Kate Rogers in Brooklyn, New York.
Coming up, the great inheritance. You might not believe the amount of money that will soon be passed down to the next generation.
The world has a new richest person. Amazon founder Jeff Bezos saw his wealth rise to $91 billion thanks to that run-up in shares of Amazon that we told you about earlier in the program. But it was a tight race. Shares of Microsoft also soaring today, increasing the wealth of Bill Gates, but not by enough to keep him number one. He is about $3 billion short. It's probably the only time he's been short of cash. Bezos' wealth briefly passed that of Gates, as you may recall, back in July.
Well, obviously, the world's billionaires are getting richer, but they're also getting older, and all of their money will eventually be transferred to the next generation. And the sum is in the trillions. Robert Frank has the details.
It may be the biggest inheritance ever. The world's billionaires are about to pass down trillions of dollars to their kids, and the cascade of wealth could transform rich dynasties and charities around the world. According to a new report from UBS and PwC, the world's billionaires added nearly $1 trillion to their wealth last year, helped by rising stock markets, stronger commodity prices, and surging values for everything from real estate to high-tech companies. More than 1,500 billionaires in the world now have combined wealth of $6 trillion, greater than the GDPs of Japan or Germany. And a lot of that is about to be passed down to the next generation. The report estimates that $2.4 trillion will be passed down by billionaires over the next 2 decades, creating a collective inheritance of unprecedented size. About 2/3 of that will go to billionaire children and their families, and about 1/3 to charity.
We believe that this is the largest wealth transfer from billionaires to either to the rising generations as well as philanthropic causes and cultural institutions that they care most passionately about, whether it be private museums or great philanthropic causes. We're seeing a great wealth transfer to these philanthropic causes for people, things that people are truly passionate about.
Now, the pass down will be especially large in the U.S. and Europe, where nearly half of today's billionaires are over 70 years old. The question now will be what those lucky heirs and heiresses and the charities do with all that new money. For Nightly Business Report, I'm Robert Frank.
And finally, tonight, earlier this week, we told you that Paul Newman's watch was up for auction. And tonight, we can tell you that it sold for nearly $18 million. That set a new record for a wristwatch sold at auction, according to the New York auction house Phillips. The timepiece was given to Newman by his wife, the actress Joanne Woodward. Newman is said to have worn it daily between 1969 and 1984. The watch came to the auction house by way of James Cox, who dated Newman's daughter Nell and, according to Forbes, remains a close friend. Newman gave it to Cox in the 1980s when Cox said he didn't have a watch. The winning bidder has not been identified, and a portion of the proceeds will go to Nell Newman's charitable foundation.
Such a great story, isn't it?
Really wonderful. And it was inscribed, "Drive carefully" by Joanne Woodward because he was such a race car driver.
Yeah, wow. Great story. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Have a great weekend. Drive carefully.
Yes.
We'll see you Monday.